Hi, my name is Gary Mishuras. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. Previously, we talked about how do I make buy and sell decisions for an investment once we followed the 5-step research process and valued the company. And next, we're going to talk about portfolio management. However, before we do that, we really need to talk about risk, because at the end of the day, portfolio management is about managing risk. So let's talk about risk broadly, and then we'll talk about specifically how do I apply it to the portfolio. So there's more than one risk. When people say risk, they can mean different things, or there are multiple things. So there are two schools of thought in general. So the common view is that risk really is about deviating from your benchmark. And that's what most mutual fund managers care about. They worry about underperforming a benchmark or peer group and looking foolish and frankly losing clients because of that. And that's one risk. Certainly it has implications for the business risk. But as a measure of an investment risk, I think it's quite flawed, because you really don't want to be too much worried about short-term performance versus a benchmark. And you want to think about risk as a human being. Like, what would, if you have $1 million and that's your retirement portfolio, or if you have $10 million and that's the money you're living off of, what is risky? Well, risk really is losing that money, or losing, more importantly, the purchasing power of that money, so you can no longer meet the goals that you set for yourself financially. So that's really the way I think about risk. It's really permanent capital loss. Now, along the way, you can think about what else can cause risk. And at the extreme, if the path to get somewhere is very volatile, so if there's a lot of performance up and down, that can translate into permanent capital loss only if the investor decides to act on that and becomes perhaps irrational and locks in a poor price based on fear of short-term performance. So I think it's very important to have a rigorous process, to have a long-term view, and really focus on thinking about risk with respect to whether or not you're likely to lose capital permanently, as opposed to thinking about risk in terms of how much will your portfolio wiggle in the short term, either in absolute terms or relative to the benchmark. So when we're talking about risk, we're talking about minimizing the probability and magnitude of permanent capital loss.